Is RAM ETF on the verge of a catastrophic breakdown, or is this the ultimate leverage discount before an explosive rocket ride to the top? The Roundhill T-REX 2x Long DRAM Daily Target ETF is flashing intense, high-risk technical signals, and the broader trend has been under immense pressure. Yet, despite the recent selling waves, a handful of high-risk traders are pounding the table, insisting this asset is completely undervalued and primed for a short squeeze. Who has this right, and who is walking straight into a brutal financial trap? Let's look at exactly what is happening behind the scenes. Trading under the ticker RAM, this is not a normal stock. It is a highly aggressive, leveraged exchange-traded fund designed to deliver 200% of the daily performance of the DRAM semiconductor ecosystem. It is hyper-focused on the memory chip market, tracking the massive cyclical swings of global data storage, artificial intelligence hardware, and high-performance computing demand. The fund is under intense market scrutiny right now because memory chip pricing has been notoriously volatile, causing massive swings in the underlying equities. Before we break down the charts and the compounding risks, do me a massive favor. Smash that like button, subscribe to the channel right now, and leave a comment below. Seriously, drop a comment with your prediction. Is RAM ETF a screaming buy for a fast double, or is it a dangerous value trap? Let me know your thoughts, and let's get straight into the data. When you analyze the technical charts, the situation gets incredibly intense. Because this is a 2x leveraged product, the price action shows an amplified, grinding downward channel with lower highs and lower lows over the medium term. Short-term momentum indicators like the relative strength index show deep structural weakness, hovering near oversold territory as aggressive short sellers keep pushing the price down. Every minor intraday relief rally over the past few weeks has been violently rejected at key moving average resistance levels. Volume spikes have primarily been on down days, indicating that institutional players are de-risking. However, we are now fast approaching a historically significant support zone. If this support holds, it establishes a perfect base for a violent double-leveraged reversal. But if it breaks, the technical floor completely drops out, opening the door for an accelerated move downward. This persistent technical weakness is exactly why market commentators remain intensely divided on the direction of memory chips. Looking at the latest consensus ratings and quantitative trading signals for the underlying hardware companies, sentiment has turned noticeably cautious. We have seen a wave of downgrades from major investment banks, citing near-term inventory gluts, pricing pressures, and a temporary cooling in hardware capital expenditure. Multiple algorithmic trading models are flashing negative short-term signals, keeping the immediate outlook for RAM incredibly murky and highly dangerous for anyone holding overnight. This sets up the ultimate debate dominating the trading boards. Is RAM genuinely undervalued, or is it a classic leverage trap? The bulls firmly believe the asset is on a massive discount. They argue that the global demand for high bandwidth memory to power next-generation AI models is an unstoppable secular trend. They look past the temporary cyclical dip, viewing it as a rare gift to accumulate a 2x leverage tool right before the next massive chip supply shortage drives prices through the roof. The bears, however, scream leverage trap. They point out that because of daily rebalancing, leveraged ETFs suffer from volatility decay. If the memory market moves sideways or experiences a prolonged downturn, the decay will erode your capital even if the underlying stocks eventually recover. They argue that buying here is catching a double-edged falling knife. The downside risks here are massive and cannot be overemphasized. The memory chip industry is notoriously cyclical, driven by brutal boom and bust supply cycles. If manufacturers overproduce while enterprise demand stalls, chip prices collapse and the underlying stocks drop, meaning RAM drops twice as fast. This exact volatility is why retail traders get trapped so easily. Retail buyers see a recognizable high momentum asset dropping, assume it's cheap based on previous highs, and buy in blindly without understanding how leverage decay works. They fail to realize that institutional capital can keep applying pressure for months, and holding a 2x long fund during a prolonged decline can lead to permanent capital destruction. Let's map out the absolute best case and worst case scenarios for this fund. The bull case relies entirely on a sudden surge in DRAM spot pricing and a flawless macro recovery. If data centers and smartphone manufacturers run out of memory inventory sooner than expected, chip pricing will skyrocket. This would trigger a wave of aggressive Wall Street upgrades across the semiconductor sector, sparking a massive short squeeze and a violent double amplified rally back to fresh highs for RAM. On the flip side, the bear case is a nightmare scenario of a prolonged global tech slowdown. If high interest rates continue to squeeze corporate tech budgets and memory supply outpaces demand, revenue for these companies will shrink quarter after quarter. This would force analysts to aggressively slash future earnings estimates, triggering a vicious continuation lower that could wipe out the vast majority of the fund's value. When deciding how to play this asset, you must clearly separate the short-term outlook from the long-term perspective. In the short term, expect highly choppy, frustrating, and incredibly volatile price action. The negative technical momentum and cautious chip analyst commentary will likely act as a heavy ceiling over the fund for the upcoming weeks. But if you lift your gaze to the long-term horizon, the fundamental landscape for digital data storage and AI computation remains massive. The global demand for computing power is growing, and these memory components will remain foundational to the global economy when the dust settles. So, what is the ultimate move here? Are we looking at a temporary cyclical low that will reward brave, disciplined traders with massive short-term wealth? Or is this the beginning of a fundamental breakdown that will crush anyone bold enough to buy the dip? The charts are screaming danger, but the underlying tech needs hint at massive potential, leaving the entire market guessing what happens next.